Hi, I'm Santiago. Today we will explore the applications of large language models to credit evaluations. Our starting point will be the paper from Sung Woo Jeon that designed an LLM system to improve response time for evaluation of credits of small and medium businesses. We will learn how large language models can improve the customer experience, diminish the risk for loans, and reduce costs, increasing both benefits for customers and for institutions. So let's take a step back and understand what are the customer problems when applying for loans. In particularly, let's start with the small and medium businesses. And the first problem is that it's a repetitive, rigid application process. So let's assume that there are 20 different institutions that can grant a loan for a given business, for a small business. The process of applying is repetitive. It goes through the same steps for each institution, especially the smaller the business it is. And also it's rigid in the sense that maybe the business is a good business, it's actually growing, it's a growing business, but there are fixed requirements and not all of them the customer is able to fulfill, and that causes them to not being able to access that capital to generate growth. And this is not only a loss for the customer, it's also a loss for the institution because it lost the opportunity of grant a profitable loan. The second customer problem is that administration costs are passed to customers as fees. So when a bank is or an institution is evaluating a credit, it requires to have a person to evaluate the application, to do due diligence, to manage the portfolio of credits, to adjust the risk profile, plus, of course, all the marketing and sales costs. And these administrative costs are passed as fees to the customers. So usually there's besides the interest rate, there's a second charge, it's much smaller, like a 10%, but still important. And also part of the premium of the credit is not only for the financial risk, but to offset the operation costs of the bank. So if we can efficient the process of evaluating loans, maybe not the entire process, but at least parts of the process that are human intensive, that are slow, and that create costs, those costs, part of them will be passed on to consumers. And the final one is that there is low liquidity and no adjustment as risk is decreased. So considering that this process is repetitive, it is slow, usually for example, when purchasing a home, the interest rate is fixed. However, as the years progress, the default probability decreases. And in that sense, there is no liquidity for easily renegotiating credits and benefiting customers that have been paying up, because we have an illiquid market. So that's the third problem. It's a bit more difficult to see. It's maybe not as important, but it's an area of opportunity. So what are some of the use cases for large language models? The first, and I really want to focus on this, is reimagining the customer experience. Because today, most applications are a form with maybe 10, 20, 50 questions, and that needs to be manually filled. I apply to startup accelerators, and it's a not fun process. It's not a non-enjoyable process. It's a dreadful process And it's a process that provides little value. It's almost like applying to jobs, little value to the person that is investing their time, while they could be either, in the case of an applicant, they could be investing that time in their business, demand generation, product planning, strategic alignment, provider negotiation, etc. Similarly, for the job applicants, instead of being learning, developing their skills, growing their network, building a brand, they are applying to job applications that very rarely will they get some feedback. So if we reimagine that experience to chatting with a large language model, then not only is it a more enjoyable experience because it's not like, oh, I have 50 questions I need to answer, but there are few very interesting opportunities, and I will try to say briefly three. The first one is fast evaluation. So maybe after the first three questions, I know that I'm not a good fit for the bank. Maybe there's some certain regulations, maybe the amount that I'm asking is not enough or too big. There are prerequisites that I'm not fulfilling. And instead of answering the whole questionnaire, I get early feedback. The second is that I might actually get some feedback from the large language model saying, okay, maybe not always, but there's the possibility. There's the possibility to reimagine the customer experience. Let's imagine if I'm applying for a credit as an individual, and I'm chatting with the large language model, and the large language model says, "Hey, we want to give you the credit. Your employment history is good. However, you are exceeding the optimal disposable income, and you are not prepared for an emergencies. So then in 6 months, when I apply for a home again, then I will know, okay, I need to reduce by 10%, 20, even 30% my disposable income. And with that feedback, I'm able to get the loan, which if otherwise I would just simply don't know. Why am I not being granted this loan if I have recurring income, if I have a decent enough credit history, if the home I'm purchasing, it's a solid investment? Now I know. And the third part is more in the benefit of the institutions, and I will dive deep on this later, about the ability to dive deep, to customize, to iterate on the process, iterate while asking the application. So again, this brings the benefit of velocity and of reduction of costs. The next use case, and we will go dive deep in this, is to improve the model's accuracy. There are two main directions where the model can provide value to the customers. The first is by the ability of reasoning. So the large language model has the ability, okay, this person defaulted this credit. Here is the history of transactions, and here's the information we have about the customer. So that's the first, applying reasoning process to evaluating credits. The second part is on the ability to extract more data. So, okay, before we had only, let's say on the profit and revenue, we had the financial statements of a small business, but to facilitate in our model, we only consider the bottom line, the revenue, the income, the margins, etc. However, a large language model has enough understanding of language that can understand, okay, the expenses, how are they distributed, which profiles, which customers are similar in terms of expenses, the news, the environment, the industry, this small business. So it can increase the universe of data used for analysis. And the final use case of large language model is reduction of costs. So if there's a process that right now is being made by by a person, and we can automate at least part of that process, that brings an opportunity to on the credit evaluation part. Again, we saw in the meeting the first part, like we can maybe we require 3 meetings to grant a credit, and if we can decrease it to 2 or 1, we are decreasing our cost by 1/3 or 2/3. The second, the analysis of credits. Okay, when we are rebalancing our portfolio, maybe the most there could be a queue system where the credits are, okay, these ones we know that the LLM knows that are not in, the probability is not good. These require a human expert, and these are good. And again, we reduce a manual process that maybe happens from 100% to maybe 20%. Payment collection. Again, there are so many processes during the pipeline of credit evaluation and credit assignment that can be automated, and those costs are reduced, and the benefits split between the institutions and the customers. And here now I want to dive deep on the first use case of the textual data. This image is the prototype of the large language model of the implementation proposed. So it starts with an initialization. It creates a dictionary, a knowledge base of the data of the customer, includes the financial data, revenue, profit, asset, liquidities, has some sort of ratios, financial ratios like technological innovation, research and development, patents, etc. And maybe an outside exploration of the market competitiveness indications, an analysis of the organizational structure, operations, number of employees, revenue by employees, again, more metrics. And finally, organization culture, maybe in social media, maybe in legal documents, maybe Glassdoor, etc. And the model extracts those data to include in their decision making. Here a couple more that I will go in deep dive, the transaction history. So if we are able, and for a small business, I think it's feasible, at least to a certain extent. Okay, you have certain amount of expenses. Please provide the invoices for the 60%, for the largest 60%. And we can get that information. And especially if we can start creating a history that tells us, okay, they are investing in growth, so they are an excellent customer. Or maybe they are using this for cost reduction. Okay, we have also a good history of cost reduction if we assume that the demand is stable. And those type of subtleties are extremely interesting and are able to be captured by the large language model. Second, the financial statements. We already covered a bit. I already said the example before of diving deep on the particular items. Comparison of financial statements is an important one. There will be a future video diving deep on this. Another useful aspect of financial statements is they are parsing them if they are not standard. There are many things. I already spoke a bit of this. Competitive analysis, we saw it. Research, and finally social networks, which can both, the third and the fourth, can be a great indication for demand. Okay, is this business actually getting demand or not? And this is a great signal that the credit for a small business will be evaluated. For personal loans, again, these are also, for example, in terms of, again, let's take a bit aside the part of privacy, but understanding how the person writes, communicates. This can be analyzed by a large language model, even during the application process, to assume, okay, the education level, the personality traits. There's a very interesting part of research that we have start correlating financial trends. And very important, I want to emphasize this, very important, this doesn't have to be prescriptive, deterministic. This can be in terms of with a learning mindset, with a growing mindset. We say, okay, this particular customer has these tendencies. Maybe it's very quick, very rush to make decisions, and that feedback can be passed to the customer. So you are exchanging that privacy data for feedback that is actually valuable for customers. And in the end, the customers will improve. So that's one. Model optimization. Now I want to talk a bit about how, sorry. Now I want to talk a bit about using the large language models, diving deep. I already mentioned this as a use case, but how to use the model optimization as part of the, how to use the large language model as part of the improving the model. So the first example is in pre and post mortems. So we have a credit and we can automatically, after granting the credit or even before granting it, what could go wrong with this credit? And ask for a reasoning process to the model. Similarly, we can explore our default loans or defaulted loans or the ones that have high likelihood, and we can say, hey, what is going wrong with this model? Oh, there are no sales, costs are increasing, we have a supply shock, and we can start creating variables, abstracting variables that signal, that indicate what is the source of the problem. So that's the initial one. Let's go with the second one, follow-up and deep dives. Again, I already explained a bit, meaning extract. While we are asking, and I want to start with an example here. Let's assume a customer has reduced their income and they are asking a credit because their income has been reduced. So the customer actually has invested in an expansion of their warehouse that will allow them to increase their income after the construction is complete. But today they have reduced income and they are asking for working capital, for an increase in working capital to offset some construction costs that didn't go. That's a high risk, a high interest rate, low risk model. It's a phenomenal business. It's a phenomenal business. What else? What else do we have? What else do we have? So the idea here is that we are able to, and the part of follow-up is interesting. I will go to it. But the part of deep dive is customizing the model to learn more about the customer. Maybe we use this information in the future as part of the pre and post-mortem, or maybe we use them at the moment, but we are collecting this additional data. Now, I want to go with the follow-ups. While you are collecting payments, you can ask a couple of questions. Maybe you grant a small benefit. I don't know, to understand the customer. Interesting, no? You are purchasing data, basically. And this, you can use it to predict future market conditions. So let's assume I have a customer in a particular industry. Let's call it construction again. And I can ask a couple follow-up questions during the collection process. Okay, I see your sales are slowed down. Why is it? Hey, I see and we can aggregate all these different demand into a. So it's beautiful. It's phenomenal. It's fantastic. It's amazing. It's amazing. It's amazing. Financial planning services. What's that about? Financial planning services. What's that about? I already preluded this. So we have this robo-advisor that coaches the customer to improve their credit worthiness, or even better, their probability of payment. So we have a 2-year credit, and we start to see that the customer starts making some bad decisions, and this credit is at risk. And we can nudge the customer. We can even tie the risk to the customer. Hey, we can decrease your interest rate 1% if you change these parts of your spending history. Wow, that's something quite spectacular. Again, there are some sort of ethical concerns that I definitely invite you to provide your perspective, because I think ethically is mostly an individualistic perspective. That in itself is an extremely intense comment. But again, I want to hear you. I'm here to talk about the technical part. And later, while we discover what's possible, we can define what's desirable. So, but the idea here is to include these robo planning advisors to decrease the risk of no payment. And again, I want to emphasize the possibilities. So, for example, again, I want to be very emphatic on the possibilities. So maybe this person has an actual problem, like needs some sort of help, like something either that the insurance didn't cover, or some sort of situation that required to lose their job, and that information can also be useful to help the customers. To say, hey, if you want to donate, hey, things, let's go through the other side of the credit loaners. These are people that are paying their credit, their income is growing, their risk is decreasing, and we can say, hey, we give you 2 options. We can decrease your risk, or you can donate to these people. It's a beautiful business model, a beautiful business model, absolutely beautiful business model. And finally, let's talk about credit renegotiation, balanced portfolio. What's this about? I already covered. I don't want to spend so much time on this. So it's basically just about, we have these credits and we have this portfolio, and we want to understand how our portfolio is composed so that we can offset certain risks. So if we see that there's this particular industry where we have more credits that we would like, then we could get those insights and start shifting our portfolio, even negotiating our portfolio across different institutions that want to also offset. Maybe they are looking for higher margins. They have a very safe portfolio, but they are not getting the return on investment they would like. And of course, this is causing investor capital to move away. And the most interesting part of this is that this can be done by automated agents via different institutions. So institution A is talking to institution B, and that's it. That's it. So let's go with that. A couple more. This is in full transparency. This is one of the ideas I'm working in. Part of me recording these videos is that I'm learning about both the technology and different industries, so that I can understand what are good startup opportunities. And this one is the first one that I'm seeing in this particular market, in the credit evaluation market. And let me start by saying that there are two actual goals when assigning credit. And I will say something cute here. The finance, in particularly investing in credit, granting credits, is about traveling through time. Granting credits is traveling through time. I'm allocating these present resources on this future stream of income. And there are two main problems to be solved in this. This is conceptual. This is at a high level. The first one is maximize the opportunities. So if I have a limited set of resources today, I want to maximize the assignment of my scarce resources on the many different possible revenue streams. And we can even say, in terms of cognitive neuroscience, we have many thoughts, we have few actions. We have 1,000 thoughts, we can only have one action. So that's the collapsing of reality that happens in finance. And we want to find that optimal future path. So that's the first problem, hugely important problem. Difficult problem, maybe uncapped problem. Maybe one could say that there are infinite gains across some paths, or approaching infinite gains, especially those that are exponentially. All of them are infinite. How soon they get to infinite is basically the problem. So it's a very difficult problem to be solved. There's a smaller, less interesting problem to be solved. And that is the transaction costs. How much am I spending to evaluate these different decisions? And I'm spending either in time, basically in time and resources. Let's say I have 1,000 different options. If I take 100 different job applicants, if I spend 5 minutes in each option, I'm spending 5,000 minutes. I'm spending 60. I'm spending something around almost 100 hours, more than 2 weeks. I'm spending more than 2 weeks evaluating. And of course, I only spent 5 minutes. It's probable that from these 50, I will need to get 100 different options, and in each of them spend 30 minutes. I can get then something between 20 and 12. I can spend 5 hours on each one. And finally, I can start in the top 3, actually pursuing that possibility before the contract is signed. So that, and I hope you see the analogies, the similarities between the recruiting process and the credit assignment process, which what has in itself is the decision-making process. So that's the first. But of course, the first problem is to find the ideal candidate. The second problem is to minimize the costs of spending that candidate. And there, again, I want to emphasize, there are two types of costs. The cost for me, of course, the candidate, the customer is also facing costs, but the first cost I have is the evaluation process. The first cost I have is how much I'm assigning to those processes. The second cost I have is how much I'm losing that opportunity time. So if I have a compounding investment opportunity, and if I grant the credit in 1 year, then I already lost, not only did I lose the earnings from that first year, I lost the compounded earnings. So it's quite something. And it's even worse because if I'm too slow, I might even lose that opportunity entirely because that opportunity is negotiating with other investors. So this is the part that a centralized data repository to minimize transaction costs. And let's understand that these transaction costs are originated from information asymmetries. So what's that? I'm as a credit applicant, I have full knowledge about my likelihood to pay. But the institution does not have the same transparency. They might have a better understanding of my likelihood to pay, but since they don't have enough data, they cannot feed that data into their models to better assess. And how do they offset that information asymmetry? By increasing the risk. And since we as a society, as a species, are risk averse, that translates in that as information asymmetry is not linear, but rather is either convex or concave. Convex is convex. So it grows more than the actual default probability. So that's the first part. If we can have this centralized data repository, there is an opportunity to reduce the information asymmetry. So let's see first, of course, who want to willingly give their data. So let's talk about the customer incentives, particularly the applicant's incentives. And we already discussed that a small business, a seed startup needs to go through thousands, or maybe not thousands, dozens of different application processes. And if I'm asked, okay, you could reduce the time that you are spending applying for credit by a factor of 10, meaning you will be only spending 10% of that time. Instead of spending 10 hours a week, you will spend 1 hour. I'm willing to offer, maybe not my entire information, but I'm willing to offer, I will consider that's a good value proposition for me. Of course, I'm losing something. First, the privacy, of course, but in a business context, I'm losing potentially competitive edges. Why do companies sign NDAs, non-disclosure? Because they understand that information is power and that the growth of information can can lose their competitive advantage. So that's the first one. I'm willing to lose part of that capital, intangible capital that I have for an efficiency in time. It's a trade-off, but it's an incentive. Now, how do we offset that incentive? And this is where it starts to get very interesting, because right now we have AI enablement. So we can say, for example, okay, I will not, as a centralized data repository, I will not make available your information to everyone. No, I will not do that. I will only make it available with who has a good fit for you. So I'm conversing with these institutions. These institutions are also sharing the data, how much they are investing, how much capital do they have available, what is their default rate, in which markets do they specialize, what services do they provide, what differentiate them from competitors. And based on those two, I'm matching, or I'm not, the AI is matching. And with that, it's partial revealing of the process. So the bank can have either their own LLM agents or agents to get some of the information and make a decision whether I'm interested in pursuing this credit opportunity, and similarly for the AI investment. And there could be some sort of tangible proposal. Hey, I'm looking for this and I'm looking for this. Hey, I'm looking for this extra information. Can you provide it or not? So this is an AI-enabled power. And again, this doesn't need to be humans communicating in this marketplace that we are creating, in this platform. We are creating a autonomous communication system where different parties negotiate autonomously with a centralized knowledge that creates a liquidity of information, of course, through the markets. So extremely interesting idea. And this is not an innovative idea. We already have credit scores that provide us those similar type of information when granting credit. The idea is to take this to another level, to use AI to be comfortable with the amount of information we are sharing. And the one, and I mentioned, this is an idea that I'm actually evaluating. And the one that I'm thinking of is in the startup market. You have thousands of startups created each year. You have thousands of potential investors, and the time is very limited. A startup has a very small window of time where they can actually raise capital to start building and go to market. And the time spent to this fundraising process is devastating. It's actually a problem that hinders innovation. So what's that? I want to focus on a very specific example. Some quotes from investor. Fundraising is a full-time process. Sometimes there's a single person in the founder team that is assigned to invest, to raise capital. They meet with hundreds of people. Just imagine how level of inefficient that is. You have the best person, sometimes the CEO, who should be the best person, investing in time. It's not entirely lost time because there's some strategization going around, but without a network, doing cold emails, doing applications, it's a terrible business model. And it's also very prejudicial for small investors because they do not have the time to evaluate these different startups. And maybe they have a deep expertise in the matter. So what's going on? What's going on? How can we help to bring liquidity to these markets? And very importantly, the seed investment market is not only a capital market, it's also a service market. You assume that the investors you have provide you with a competitive edge. It's not like I'm only getting money, I'm only getting capital. No, you are getting a brand, you are getting knowledge, you are getting expertise, you are getting a network, you are getting a future capital as well. So that's when in this very complex market, it's a great place not only to reduce the transaction cost, but to actually improve the decision making. Let me know if you find this idea interesting, and we are close to finishing with some discussion ideas. The first, simply, what other innovations you are seeing in this market? I offer 3 of them. The first, improving the customer experience. The second, improving the models, decreasing the risk. And the third one, reducing costs, automating tasks. Are there others? Interesting question. I'm sure there are, but I invite you to comment on this. Are there other opportunities to improve the customer experience? And this was not my core insight. Again, I cited the paper at the beginning. So are we, is it possible? Is it possible to imagine another customer experience different than the one proposed by the researcher. I don't know. It's a good question to ask ourselves. Third question: technical innovations to improve accuracy. Again, I propose 3 of them. The first, or at least the pre and post-mortem. I also talked about the increase the iteration, the robo-advisors, the follow-ups and deep dives, the extra data collection. So I propose 3 or 4 different ideas to improve the accuracy of the model through technical innovations. Are there more? Again, I would love to hear your thoughts. And finally, do we find markets with similar dynamics? And I do want to explain which are those particular dynamics. First is this marketplace dynamic. Second is the decision possibilities, the scarce versus that we have a collapsing of reality, that we have many different possibilities and we have to find the best one. It's a decision-making process. So first is marketplace, two-sided market. The second is decision-making, and the third is the costs, the evaluation, the analysis costs. So which other are they? I already mentioned recruiting as one of them. Are there any other? I mean, which others are there? There are many of them. And with that advertisement, I'm looking to build a community. I want to find 100 curious, smart persons to start engaging in a Slack base. I imagine this as a place to dream, to create opportunities, to share opportunities, to learn together, to all these discussion questions that I'm proposing. I would love to not only read them to you, but read them from you, but actually that these ideas start generating momentum among you, among us, and just either have fun discussing them, training our mind, using our mind, but also making them a reality, to use technology to solve important problems like climate change and poverty. Big problems. That's my goal. That's why I'm sharing this content. And I hope you're interested. If you are not interested, refer someone. If you are not interested but liking the comment, give me a like, give me a share, give me a subscribe.